Hello everyone. Today I'm going to talk about a very common investing mistake which I see people keep on making, and I came to know while I spoke to many investors, clients and prospects. And the mistake is people have become so focused on avoiding taxes or not booking their losses that they are stuck in bad investments. Let me explain. Whenever I give a review on the portfolios, sometimes I suggest exiting an average fund, replacing a weak stock, reducing some sectoral or thematic bets, and shifting to some investments which are more aligned to your financial goal. And many times the first reaction I receive from the investors is, but if I sell now, I will have to pay taxes, or my investments are still in losses, so I will sell once they are back to my cost. Now, to be fair, these are very valid concerns. Taxes matters and nobody like to book losses. But the bigger question is avoiding tax more important than improving your portfolio? This is where most people use first order thinking. First order thinking says that if I sell, I will have to pay taxes. So exactly, don't sell. Simple, immediate and emotional. But smart investing often needs second order thinking. That means asking what happens after I sell, what is the amount of money I receive, and where can I reinvest, and this money, if reinvested, can work better for me. These are the real questions. Let me give you a real life example. Recently, I was speaking with a prospect and they were holding certain investments that were very average quality and were no longer ideal for their current situation. And there were clearly better options available in the market, but they were hesitant to move on because there would be a tax liability on their head. So mentally they were stuck only on one number, like how much taxes I will pay. So they were not thinking about another question, how much wealth I might lose by staying here. See, taxes are visible. You can calculate them immediately, but the opportunity cost is invisible. You don't get a bill for it. You don't receive a message saying that you lost 3 lakh by staying in these investments. So most people ignore it. But sometimes the invisible cost becomes more bigger than the tax itself. Imagine this. You avoid paying 50,000 as a tax today. This sounds absolutely smart. But because of that, you remain in poor investments for the next 2 to 3 years, while a better alternative compounds much more than your existing investments. Now ask yourself, what was actually expensive, the 50,000 tax or the years of growth lost? Same thing can be applied for exit loads. People hate paying exit loads and that's totally understandable. But if your investment is no longer suitable, sometimes paying a small cost and reallocating smartly elsewhere can be a better long-term move. And now a very important clarification. I'm not saying you to buy and sell constantly. I'm not saying taxes don't matter. And I'm definitely not saying that churn your portfolio very often. See, good investing needs patience, but blind attachment to old investments is a risky move. So before deciding to hold anything, ask these 5 questions. Is this investment still right for my goals? Is the risk still suitable for me? Is a better alternative available? And what is the after-tax outcome if I switch? And what is the cost of not doing anything? And the 5th question is powerful. What is the cost of not doing anything? And this becomes absolutely important in sectoral and thematic funds. Many people enter these type of funds in excitement and then they hold them for years because they don't want to book a loss or they don't want to pay taxes. But markets do not reward emotional attachment. They only reward rational decisions. And good investing is not about just returns. It's about thinking clearly. And sometimes clear thinking means accepting a small visible cost today for a better outcome tomorrow. So what you can do is just plot 2 tables. First, calculate your returns or maybe the end value of your existing investments. And on the second column, just calculate if I pay taxes right now, what would be the money available to reinvest and what would be the expected returns. If the amount is higher in case 2, this would be a wise decision to sell your existing investments, pay taxes and move to a new one. If you found this useful, do subscribe to us. I share practical knowledge on investments, financial planning and wealth management. Thank you for watching.